The smartest investor on earth spent nearly 3 years being questioned for doing what looked like nothing. Bloomberg ran headlines about Berkshire's cash pile baffling Wall Street. Analysts wrote long notes about capital misallocation. Financial Twitter did what financial Twitter always does. And through all of it, Berkshire Hathaway kept stacking cash and treasury bills as if patience itself were a business model. And in a way, it was. By the first quarter of 2026, Berkshire Hathaway was holding roughly $397 billion in cash and short-term treasury bills, the largest liquid reserve in the company's history. A sum larger than the combined cash holdings of Apple, Amazon, Alphabet, and Microsoft. Large enough, according to analysts, to buy outright hundreds of companies in the S&P 500. But that money was not sitting idle. With government securities yielding around 3.7%, Berkshire's cash reserve was generating annualized interest income approaching $12 billion. A multi-billion-dollar stream of earnings built largely from restraint. Now compare that to the average household. The median emergency savings balance people report today is around $5,000, down sharply from the $10,000 reported in 2025. And nearly 1 in 4 Americans has no emergency savings at all. Somewhere between $397 billion and zero is the real divide between the investor who stays in control and the investor who gets pushed around by circumstance. And that difference has surprisingly little to do with stock-picking skill. It has everything to do with something most people never hear explained clearly. Not returns. Not diversification. Not dollar-cost averaging. But cash. What cash actually is. What it does. And why understanding its role can completely change the way you think about every dollar you hold. Because cash is one of the most misunderstood assets in personal finance. Half the internet treats it like a mistake. $1 in savings is $1 not working. The other half holds cash out of fear and calls that wisdom. Both views miss the point. And the last few years from 2022 through now have been a perfect real-world case study in what cash does, what it doesn't do, and why it matters more than most people realize. By the end of this, you should understand 3 things. First, what cash is actually doing while it sits there, something no simple return calculator captures. Second, the exact point where cash stops being just a safety net and starts becoming a strategic advantage. And third, the 3 distinct jobs cash plays in a serious wealth-building system. Because when people treat all cash as one undifferentiated pile, they usually get every part of it wrong. Let's start with a concept from options trading, optionality. When you buy a call option, you are not buying the stock itself. You are buying the right, but not the obligation, to buy that stock later at a specific price. That right has value because it gives you flexibility. Cash works the same way. Cash is optionality in its purest form. It gives you the right, but not the obligation, to act. To respond to an emergency. To buy into a market decline. To step into an opportunity quickly. To choose. And unlike a formal option contract, your cash does not come with an expiration date. It doesn't pressure you. It just waits, available, ready to be deployed the moment the right situation appears. That is its power. The mistake most people make is pricing cash at zero. They look at money sitting in savings and see dead weight. They compare it against a hypothetical stock market return and feel guilty for not investing every last dollar. But that calculation ignores the option value of liquidity. And the option value is enormous if you understand what you're holding. Cash doesn't just sit there. Cash waits with purpose. Now let's talk about what happens when you don't have it. Because this is where the story turns from theory into something much more painful. Most people think the danger in investing is losing money in a downturn. That's not the real danger. The real danger is being forced to act at the worst possible moment. Imagine Marcus. He's 39, disciplined, consistent, doing what he's been told to do. He's been maxing his 401k for years. He also has around $80,000 in a taxable brokerage account. What he does not have is a cash cushion. Why? Because he's heard the same message many people hear. Cash loses to inflation, every dollar should be invested, and money sitting in savings is wasted potential. So he stays fully invested. Then 2022 hits. Inflation peaks above 9%. The Federal Reserve hikes rates aggressively. Stocks drop into bear market territory. The S&P 500 falls hard, and Marcus watches his $80,000 brokerage account shrink to around $60,000 on paper. And then life shows up. His roof starts leaking. His car needs a transmission. Work slows down for a few weeks. He suddenly needs $18,000. At that moment, the issue is no longer investment theory. It is liquidity. Now, this is where I want to be fair about credit cards because they are often discussed in purely negative terms, and that's too simplistic. A credit card is not inherently a problem. In fact, used correctly, it can be an incredibly useful financial tool. It gives you convenience, fraud protection, rewards, a short-term cash flow bridge, time to organize payments, flexibility in an emergency. That is real value. But a credit card works best when it is backed by cash. If Marcus had strong liquidity behind the card, it could act as a temporary bridge while he moved money efficiently and kept his long-term investments intact. In that role, a credit card is helpful. Smart, even. The problem is when the card becomes the emergency fund. Because then the convenience turns expensive. So Marcus now has two choices. He can sell investments at a loss, or he can use a credit card as a bridge without enough cash behind it. Both choices are manageable in the short run. But only one of them preserves flexibility long term, and that's the one supported by cash reserves. That's the real lesson. The portfolio didn't fail Marcus. His liquidity plan failed him. And this is not rare. A large share of Americans still have little or no emergency savings. Many households would struggle to cover even a modest surprise expense using cash on hand. And a meaningful number carry more credit card debt than emergency savings. Again, that does not mean credit cards are bad. It means credit cards are best used as tools of convenience and leverage, not as substitutes for liquidity. They shine when they are paired with reserves. They hurt when they are asked to do the job cash was supposed to do. That distinction matters. Because the absence of cash creates invisible costs that compound over time. Selling investments too early. Interrupting recovery. Losing future upside. Leaning too heavily on borrowed liquidity. The option isn't idle. The absence of the option is expensive. Now, let's flip the story around. Because every forced seller needs a buyer. And the buyer on the other side, in every correction, every distressed market, every rushed transaction, is usually the person who has cash. Real estate gives us the clearest example. A growing share of home purchases are still being made with cash. And the reason is simple. Cash doesn't just buy property. It buys certainty. Imagine two offers landing on a seller's desk. Offer 1. For $120,000 financed. Bank approval pending. Appraisal contingency. Financing contingency. Long closing window. Offer 2. For $100,000 cash. Fast closing. No lender delays. No appraisal risk. Minimal uncertainty. Which offer looks more attractive? Very often, sellers choose certainty. And that principle extends far beyond real estate. Private business sales. Distressed debt. Equipment auctions. Startup secondaries. Any market where a seller has urgency, timing pressure, or liquidity needs, the person with cash has an asymmetric advantage. Because cash closes. Cash simplifies. Cash reassures. And that often earns a discount. Warren Buffett demonstrated this perfectly during the financial crisis. In 2008 and 2009, while others were scrambling, Buffett stepped into deals on extraordinary terms, not because he could predict the future better than everyone else, but because he had liquidity when liquidity mattered most. That is optionality in action. The cash had been sitting there for years, quietly, until the moment arrived to exercise it. And you do not need to be Buffett for this principle to matter. When markets corrected sharply in 2025, investors who already had cash available were able to buy broad indexes and quality assets at meaningful discounts. They didn't need brilliance. They needed preparedness. That's the pattern. The cash has to be there before the sell-off, not after. Not once the headlines turn ugly. Not when you start thinking about raising some liquidity. Before. Because if you're trying to create cash in the middle of a downturn, you're already behind. Now, to be clear, the advice to stay invested is not wrong. Historically, remaining invested for long periods has been one of the most powerful wealth-building strategies ever observed. Missing just a handful of the market's best days can dramatically reduce long-term returns. That is true. But here's the nuance that often gets skipped. Many of the market's best days happen very close to its worst days. So the investor who wants to buy into panic needs dry powder already available. The setup for good decisions happens in calm periods, not chaotic ones. And that brings us to the deeper point most calculators miss. Cash is not just about return. It is about structure. It is what allows your long-term assets to remain untouched. It is what allows you to absorb shocks without disrupting the plan. And it is what allows you to act decisively when markets temporarily misprice opportunity. That's why thinking about cash as one single pile is such a mistake. If you're serious about building wealth, you need to think in 3 distinct cash buckets. Each has a different job. Each should be sized differently. And each changes your behavior in a different way. The first bucket is the firewall. This is your emergency cash. Not a vague 3 to 6 months rule copied from the internet. A real number based on your actual survival expenses, housing, utilities, groceries, insurance, and minimum debt payments. Strip out everything discretionary. The job of this bucket is simple. It makes sure you are never a forced seller. That alone changes everything. It protects your investments from being interrupted. It gives your credit cards the chance to function as smart short-term tools rather than expensive long-term crutches. It lowers stress. It increases resilience. And this bucket belongs in a high-yield savings account. Not a near-zero yield legacy bank account. Not somewhere inaccessible. Somewhere liquid, safe, and productive enough to at least collect a reasonable yield while it waits. The second bucket is the opportunity fund. This is different. This is not there to pay bills. It is there to be deployed when something genuinely attractive appears, a broad market dislocation, a distressed asset, a compelling valuation setup, a time-sensitive opportunity. This is strategic cash. And the most important thing about this bucket is that it needs rules. Because without rules, one of 2 things happens. Either you freeze and never use it, always waiting for a better setup. Or you slowly spend it on things that feel urgent but are not actually opportunities. So write down the triggers in advance. What kind of correction matters to you? Which asset class? How much do you deploy at once? Under what conditions? The point is not to predict perfectly. The point is to remove emotion from the decision. The third bucket is systematic deployment. This is your regular investing flow. The automatic, boring, relentless process of sending money into long-term assets month after month. This is dollar cost averaging. And despite how unsophisticated it sounds, the long-term evidence in its favor is incredibly strong. Trying to wait for the perfect crash often feels intelligent. But in practice, regularly investing tends to beat sitting on the sidelines waiting for the ideal moment. So these 3 buckets are not competing with each other. They are sequential. Bucket 1 protects you. Bucket 2 prepares you. Bucket 3 builds you. That is how cash becomes part of a system instead of a source of confusion. Now let's talk about opportunity cost, because this is the argument that makes many people uncomfortable. Yes, holding cash has a cost. If you keep $25,000 in a high-yield savings account earning 4%, you make $1,000 a year. If the stock market returns 10%, then in theory, you gave up $1,500 of extra gains by not having that money invested. That is real. But now compare that with the cost of not having the cash when you need it. If the absence of that liquidity forces you to sell good assets during a drawdown, or forces you to lean on a credit card for longer than planned, the cost can quickly exceed the return gap. And again, credit cards deserve a balanced explanation here. A credit card can be extremely valuable when used intentionally. It provides purchase protection. It helps smooth short-term timing gaps. It can earn rewards. It can be an excellent emergency bridge for a few weeks. But its power is maximized when there is cash behind it. Without that cash, a useful tool can become an expensive placeholder for missing liquidity. So the real comparison is not cash versus growth. It is often small opportunity cost versus large disruption cost. And disruption cost is the one most people never calculate. Let's make that concrete. Imagine two investors, David and Rachel. Same income, same discipline, same overall savings rate. David has $200,000 in his retirement account and $50,000 in a brokerage account. Fully invested. No cash cushion. Rachel has $200,000 in retirement, $40,000 in brokerage, and $10,000 in high-yield savings. On paper, David looks more efficient, more invested, more optimized. Then the market drops. Both portfolios decline. Then an unexpected expense hits. David has to sell assets. Rachel uses cash. Months later, when markets recover, Rachel's invested assets fully participate. David's do not, because a portion had to be liquidated at the wrong time. That's the hidden return on cash. It may look like a drag in good times, but in bad times, it protects the compounding engine. And that changes outcomes more than people expect. This is why cash is not just defensive. It is structurally productive. It allows the rest of your portfolio to do what it was built to do, remain invested, recover, compound, and stay available for future upside. Now zoom back out to Berkshire. Yes, Berkshire is a special case. Its scale is extraordinary. Its opportunities are different. Its decision-making is institutional. But the mechanism is identical. Whether your cash reserve is $397 billion or $37,000, the principle is the same. Liquidity is not laziness. Liquidity is readiness. Berkshire is not holding cash because it is afraid to invest. It is holding cash because sometimes the option value of liquidity is greater than the immediate return available in the market. In that moment, the cash is the position. And when the environment changes, that position becomes power. That is why the criticism always sounds loudest right before the value of cash becomes obvious. It looks passive until the dislocation arrives. Then suddenly the patient investor is the only one in the room who can move with speed, size, and confidence. So here's the practical takeaway. First, calculate your firewall before you optimize your portfolio. Know your real survival number. Fund it. Second, keep that emergency cash somewhere liquid and productive, like a strong high-yield savings account. Third, define your opportunity rules in advance. Don't rely on emotion in the middle of a correction. And finally, stop thinking about cash as wasted. Cash is not dead weight. It is not a failure of conviction. It is not money that forgot to work. It is the reserve that protects your plan, strengthens your negotiating position, supports smart use of tools like credit cards, and gives you the ability to act when everyone else is trapped. The investors who win over decades are not always the ones who found the hottest stock. Very often, they're the ones who were never forced to sell the right assets at the wrong time. That is what cash makes possible. It is not just safety. It is flexibility. It is leverage. It is timing. It is optionality. And when the moment comes, optionality is often worth more than certainty ever was.